Good morning, welcome to CATEX-TV. My name is Frank Fortunato. This is a live broadcast from Princeton, New Jersey. Today is Friday, March 4th, 2011. It's 11:30 a.m. Eastern Standard Time in the U.S. It's 4:30 p.m. in London, in Hamilton 12:30, and in Mexico City 10:30 a.m. If you need to reach us during the broadcast, you can phone in toll-free at 1-866-67-CATEX. Overseas, our AOL instant mail address is CATEX-TV. The unemployment rate in the United States has dipped below 9%. 192,000 jobs were added last month, according to the Department of Labor. We're at 8.9%, the lowest rate in about 3 years. Go to our main news. Hannover Re now has weighed in. They've estimated that the latest New Zealand earthquake will cost it up to about 150 million euros. They're using an insured industry loss estimate of about $7.25 billion US. That's a little bit lighter than what Swiss Re used yesterday. Even if losses do increase, though, Hanover's losses will be limited to 150 million euros. It has retrocession protection, which will kick in above that level. Well, in Tallahassee, Allied World in Bermuda has been approved to act as an eligible reinsurer in Florida. They're the latest in a line now of 4. They've been allowed now to post lower collateral requirements. They're now going to be able to post 20% of loss reserves as collateral on property cat reinsurance in Florida, rather than the 100% required by most non-U.S. reinsurers. Here's an interesting story. Our good friend Igor Bestevro is probably happy today. Fortegra Financial Corporation in Jacksonville, Florida, announced this morning that it has agreed to acquire eReinsurer.com. eReinsurer is an industry leader in web-based technology for reinsurance process control, compliance functions, and information management. The price is $37 million in cash. eReinsurer was founded 11 years ago. It developed a web-based platform to support placing reinsurance risks. At one time, it was owned by AIG. The company is based in Salt Lake City, Utah. Well, get the trumpets out now. Finally, after weeks and weeks of unrest in the Middle East, the Lloyd's Market Association has issued the following statement concerning the wave of political protest and demonstrations that have been unfolding there. Here we go. Quote, "Clearly, there has been considerable property damage as a result of the recent civil disturbances in North Africa and the Middle East, but the extent of this will not be clear for some time, particularly as protests are continuing. As supporters of international trade, insurers will have a variety of exposures in the region, but because of the generally limited nature of the events, will not be seriously affected, at least in the short term." It goes on to say there has been an entirely different regime response in Libya, but here Western insurers have tended to stay away anyway due to the country's volatility and political isolation. For that reason, exposures are not expected to be significant other than an oil-related industry. If an authoritarian regime comes to power, further Western sanctions are possible. That would have consequences for oil traders and consumers beyond the effect on Libya itself. It's like a Delphic oracle statement. Everybody's been waiting. Here it was. Well, meanwhile, back at the ranch in Tripoli, Libya is bracing for another day of mass protests against Mr. Gaddafi, raising fears of fresh conflict between anti-government protesters and loyalist forces. Government forces have set up checkpoints in Tripoli ahead of a call by opposition groups to hold rallies after the noon prayers in the mosques today. Just about now, people should be making their way out. Some news agencies have also reported a crackdown on foreign journalists, saying security guards have attempted to block their movements. Internet services have also been disrupted in Tripoli and in the eastern city of Benghazi. Residents in Tripoli have said they are preparing for a violent crackdown by Gaddafi's forces, who say they have been roaming the city in civilian cars. This could still get quite messy. We announced last month that Exchanging, the parent company of the exchanging insurance operation, had indicated that they were not going to pay any dividends. However, Lloyd's and the International Underwriting Association do remain in line in dividends for their stakes in the subsidiary company. This will be good news for IUA members. The IUA uses the dividend shares from its 25% stake ownership in Exchanging Insurance Services to subsidize its membership fees. The CFO and interim chief executive of Insurance Services let me get the right name right, Exchanging Insurance Services, Ken Lever, told Insurance Day that the group insurance operations in London had enjoyed their best year and that he fully expected to pay a dividend to the owners of Exchanging Insurance Services and Exchanging Claim Services. He said the dividend decision for each of the subsidiaries is the subject for approval by the boards of those companies. The insurance business did well in 2010, so I would expect there'd be a dividend paid. Lloyd's and the IUA both own a 25% stake in XIS, and Lloyd's owns a 50% stake in the claim service operation. Well, we reported last week, or actually last month, that Guy Hand might be interested in purchasing Chaucer. News has surfaced today that a consortium comprising Goldman Sachs and the U.S. private equity firm TPG is interested in buying Chaucer. The Daily Telegraph is reporting this from London. Traders in the city indicated that the consortium would pay up to 61 pence a share for the insurer. Chaucer announced last month that it had received several approaches. Guy Hand's private equity firm Terra Firma had emerged as one of the suitors. Chaucer will announce its full year 2010 results on Monday, and I'm sure much more speculation will ensue. That's all the news we have for today. Have a great weekend. If we have any breaking news, we'll come back and tell you. In the meantime, thank you for watching, and we'll see you on Monday.